Hi there, accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover Chapter 4, the accounting cycle, from Warren Jones' Corporate Financial Accounting. By the end of this chapter, you should be able to describe the flow of accounting information from the unadjusted trial balance into the adjusted trial balance and financial statements, prepare financial statements from adjusted account balances, journalize closing entries, describe the accounting cycle, illustrate the accounting cycle for one period, explain why the accrual basis of accounting is required by GAAP, describe and illustrate the use of working capital and the current ratio in evaluating a company's financial condition, describe and illustrate the end of period spreadsheet, and prepare a statement of cash flows from a cash account. So as we go through this chapter, in chapter 1, we discussed the initial accounting cycle. And then in chapters 1 and 2, we also took the time to analyze recording several transactions. And in chapter 3, the cycle continued. We learned about adjusting entries. And then now in this chapter, we are essentially going to finalize this accounting cycle. It's completed by preparing the financial statements, and then we do what's called closing the books. We record the closing entries because, again, an accounting cycle is for a fiscal year, which is 12 months, or a calendar year, which is from January 1st to January 31st. So at every 1 year mark, whether it is a calendar year or a fiscal year, the books need to be closed. So this chapter, we essentially close the books. So the process of adjusting the accounts and preparing financial statements, as we have learned from the previous chapters, is one of the most important in the accounting cycle. The flow of accounting data in adjusting the accounts and preparing financial statements is summarized in Exhibit 1 on the next slide. So here we see we have our end of period spreadsheet. We have both the unadjusted trial balance, then we account for the adjustments that needed to have been made. And then from there, we have our adjusted trial balance. And then once the adjusted trial balance is completed, from there we can prepare our income statement. So this exhibit illustrates the flow of accounts from the adjusted trial balance into the financial statements as follows. So here to the far right on the spreadsheet, we have our adjusted trial balance. From there, we prepare our income statements. So the revenue and expense accounts, which we see are from lines 20 to 28 on the spreadsheet, they flow into this income statement. We subtract the total of our expenses from our revenue, and that gives us net income of $7,105. And then from there, the next entry, or the next report rather, that we prepare is our statement of stockholders' equity. So the common stock and dividend accounts, which are spreadsheet lines 18 and 19, these flow into the statement of stockholders' equity. And then we also report the net income of $7,105 that flows to this statement. So we have the ending balance of our common stock, the ending balance of our retained earnings, and then we have the total of our stockholders' equity. And then lastly, we prepare our balance sheet. The asset and liability accounts, which represent spreadsheet lines 8 through 17, are reported on our balance sheet. And then in addition, the end of period common stock and retained earnings, these also flow into the balance sheet from the statement of stockholders' equity. So that is why it is extremely important that when the financial statements are being prepared, that they must be prepared in this specific order. The income statement first, because the net income has an impact on our retained earnings, and then our balance sheet last, because we need to know our ending common stock and ending retained earnings balance. So using the adjusted trial balance, the financial statements can be prepared as we just discussed: our income statement, statement of stockholders' equity, and then our balance sheet. So here, this is just reiterating the flow. The income statement, as we know, is prepared directly from the adjusted trial balance. Start off with our fees earned, and then from there we subtract all of our expenses, which gives us our net income. And then when we prepare our statement of stockholders' equity, our net income has an impact on our retained earnings. Then from there, the ending balances from our statement of stockholders' equity is then transferred and reported on our statement of stockholders' equity through the balance sheet, our stockholders' equity section. So the income statement is prepared, as we mentioned, directly from that adjusted trial balance. The expenses in the income statement, they're listed in order of size, beginning with larger items. For some companies, it might be different. Some companies, they list their expenses in numerical order. Some companies, they will group their expenses based on their likeness. Let's say one company has utilities expense, they might group the water bill, the gas bill, etc. Then they have advertising expense. Any fees associated with advertising, marketing is grouped into one. Any legal fees grouped into one. Any other expenses. So it ultimately depends on a company, but for this example in particular, they are listed in order, beginning with the larger items. And here it says miscellaneous expenses is the last item, regardless of its amount. Then for our statement of stockholders' equity, the statement of stockholders' equity is prepared by entering the beginning balances for common stock and retained earnings. The common stock that was issued during the period is entered in the common stock column. And during the period, earned net income increases retained earnings and is therefore entered in the retained earnings column. Paid dividends during the period, which reduces retained earnings and is therefore entered as a deduction in the retained earnings column. These entries in each row, they're added across and the total is entered in the total column. And then finally, all of the columns are totaled to arrive at the ending balances for both our common stock and retained earnings. And then in addition, we get the total of our stockholders' equity as of December 31st, 2023. So for the following period, the beginning balances of common stock and retained earnings are the ending balances that were reported for the previous period. So let's say today is May 1st, 20 year one. June, at the end of, well, if we use May 31st, let's say it's May 31st, 20 year one. Now, let's say we have a balance of $300 in our account. So it's May 31st, 20 year one, and we have $300 at the end of the month. At the beginning of the new month, which is June 1st, 20 year one, our beginning balance represents our ending balance for the previous period. So this is simply what this example is stating. The beginning balances represent the ending balances for the previous period. So the statement of stockholders' equity for the year ending December 31st, 2024 would be as follows. So these balances we see here for January 1st, 2024, these represent the ending balances for 2023. Next, we have our balance sheet. The balance sheet is prepared, again, much like the other statements, directly from the adjusted trial balance columns of the spreadsheet, beginning with cash. The asset and liability amounts are taken from the spreadsheet. The common stock and retained earnings amounts are taken from the statement of stockholders' equity. The balance sheet shows subsections for assets and liabilities. Such a balance sheet is a classified balance sheet. So here we have assets. Assets are commonly divided into two sections on the balance sheet. And just so we have a quick recap, assets are essentially anything of value that a business owns or controls that will provide the company with a future economic benefit. So we have current assets, and current assets are cash and other assets that are expected to be converted to cash or sold or used up, usually within 1 year or less, through the normal operations of the business. We have notes receivable, and accounts receivable are amounts that customers owe. So it's monies that the company is expecting to receive. We have property, plant, and equipment. These may also be described as fixed assets or plant assets. And these assets include equipment, machinery, buildings, and land. Next, we have liabilities and shareholders' equity. So liabilities are the amounts that a business owes to creditors. In addition, it also represents obligations to customers. So great example, let's say a customer pays a company in advance. The company has an obligation to perform the service or provide the product to the customer. So therefore, liabilities are not just debts that business owes to creditors, it also represents obligations to customers. The liabilities are commonly divided into two sections on the balance sheet. Current liabilities are liabilities that will be due within a short time, usually 1 year or less, and that are to be paid out of current assets. Long-term liabilities that will not be due for a long time, usually more than a year. Those are referred to as long-term liabilities. The stockholder's right to the assets of the business is presented on the balance sheet below the liabilities section as shareholders' equity. So one key thing to keep in mind is that the stockholders' equity is added to total liabilities and the total must equal to total assets. So again, that is the fundamental accounting equation. Assets equals liabilities plus owner's equity. Next, we have our statement of cash flows. So while the income statement, statement of stockholders' equity, and balance sheet can be prepared from the adjusted trial balance, the statement of cash flows, this is prepared by analyzing the cash account. So I think the title of the statement itself makes sense. Statement of cash flow. So if money came into the business, why did it come in? If money left the business, why did it leave the business? So in doing so, each cash transaction is classified as operating, investing, or financing. So in practice, however, the statement of cash flows is normally prepared using a different, more complex method called the indirect method. So with our closing entries, as we've discussed in chapter 3, adjusting entries, they're recorded in the journal at the end of an accounting period. So at the end of the accounting period, in addition, there's some other things that need to be accounted for. So the balances of the accounts reported on the balance sheet, they're carried forward from year to year. Because these are relatively permanent, these accounts are called our permanent accounts or our real accounts. So the balances of the accounts reported on the income statement, however, are not carried forward from year to year. In addition, the balance of the dividends account, which is reported on the statement of stockholders' equity, the balance in this account is also not carried forward. So because these accounts report amounts for only one period, they're called temporary accounts or nominal accounts. So temporary accounts, they're not carried forward because they only relate specifically to one period. So at the beginning of the next period, these temporary accounts should have zero balances. So to achieve this, temporary account balances are transferred to permanent accounts at the end of an accounting period. The journal entries that transfer these balances are called closing entries. And the transfer process is called the closing process, and sometimes it's referred to as closing the books. So on the next slide, we'll look at the steps that are involved in the closing process. So the closing process involves the following two steps. Step 1, revenue and expense account balances are transferred to our retained earnings balance account. In step 2, the balance of the dividends account is transferred to the retained earnings account. And after these two steps are completed, there's 2 closing journal entries that are required by the closing process. So the first closing entry, we debit each revenue account for its balance, and we credit each expense account for its balance. And from there, we credit retained earnings if we have a net income, or we debit retained earnings if we have a loss. And the second closing entry is to debit the retained earnings account for the balance of the dividends account, and we would credit the dividend account for its balance. So what we see in this example is we are obviously doing the reverse. We are doing the reverse of the normal balance because we want to get these revenue, expense, and dividend account balances to zero. So when we think of closing entries, think of red. R stands for revenue, E stands for expense, and D stands for dividends. So if we do not complete this process, we will be in the red. So we need to close revenue, expense, and dividend accounts. Closing entries are recorded in the journal and are dated as of the last day of the accounting period. So here we have this example here. Closing entry is stated we debit each revenue account for its balance. Because again, if we look at the revenue account, the credit shows an increase. Therefore, by debiting it, it shows a decrease. So our revenue account now becomes zero. For our expense accounts have a normal balance of a debit. So therefore, by crediting these accounts, we are zeroing them out. So this is the first step. We account for our revenue and expenses, and we determine whether we have net income or if we have a net loss. And if we have net income, then that has an increasing effect to our retained earnings. So we would credit it. But if there's a loss has a decreasing effect to our retained earnings, hence we would debit the account. And then our second closing entry, the normal balance for our dividend account is a debit. So therefore, to close our dividends account, we would need to credit it and debit our retained earnings balance. And now here we see, and this exhibit 4 is essentially just a flow chart of closing entries for net solutions. And again, here we started off with $16,840 in our revenue account. We debit it for the exact amount to zero it out. We do the same thing for our expense accounts. Our expense accounts had debit balances. We credit it for the exact amount to ensure that our revenue and expense accounts are zeroed out. We had a net income of $7,105, and then we would credit our retained earnings account. And then lastly, for our dividends account, we had a debit balance of $4,000. We credited for $4,000, and then we debit the balance to retain earnings. So therefore, these red account balances are now zero. And then now once we get to the last step, we journalize it. Debit fees earned, debit rent revenue, credit all of the expense accounts in addition to the difference, which represents our net income. We debit our retained earnings account and credit our dividends account to close them out. And now here we see the example, our ledger with the closing entries for our cash accounts. These are our balance sheet accounts, our assets. We know that obviously we only close the red accounts, but our balance sheet represent our permanent accounts. So here we have some additional assets, we have our liabilities, and then now here we see our common stock. And then now we see, as we refer to our retained earnings, our dividend, our revenue and expense accounts, these balances are now impacted. And if we keep in mind and we pay close attention, we can see what's taking place in this retained earnings account. It mimics what is reported on the statement of stockholders' equity. On the statement of stockholders' equity, we have an increase for net income, and we have a decrease for dividends paid. And then right here, we see for the dividends, fees earned, and the various expense accounts, these balances are now zero, so they are ready for the next accounting cycle. And then for our post-closing trial balance, we see our balance sheet, and we would see that there's no revenue or expense accounts that are reported on the statements simply because those accounts were closed. So the accounting process, we started off in chapter 1, begins with analyzing and journalizing transactions, and then it ends with the post-closing trial balance, and this is called the accounting cycle. So the steps in the accounting cycle are as follows. Step 1, transactions are analyzed and recorded in the journal. Transactions are posted to the ledger. An unadjusted trial balance is prepared. Adjustment data are assembled and analyzed. An optional end of period spreadsheet is prepared. Adjusting entries are journalized and posted to the ledger. An adjusted trial balance is prepared. Financial statements are prepared. Closing entries are journalized and posted to the ledger. And lastly, a post-closing trial balance is prepared. So here we see an exhibit of the accounting cycle. We start off with the basic accounting equation, which we know is assets equals liabilities plus stockholders' equity. And then all transactions that have an impact on this equation, all transactions in event are recorded and posted. Then it's key to keep in mind as we look at these next 3 steps, we need to be reminded of the rules of debits and credits. So as it relates to our asset accounts, anytime there's an increase in an asset account, it must be debited. Anytime there's a decrease in an asset account, it must be credited. And as it relates to our liability account, anytime there's an increase, the account must be credited. Anytime there's a decrease, the account must be debited. And then for our stockholders' equity, we see our stockholders' equity consists of 4 components. We have our common stock, we have our retained earnings, which is essentially a makeup of these 3 accounts: revenue, expense, and our dividends. And as we see here, for our common stock, whenever there's an increase, it must be credited. Whenever there is a decrease, it must be debited. So increases for stockholders' equity are represented with a credit. As we see here, revenue, obviously this is money that the business is earning because they performed a service or provided a product. So revenue is increased with a credit and decreased with a debit. And our dividend and expense accounts are increased with debits and decreased with credits. So sometimes some can find this a bit confusing, but at the very fundamental of accounting, having a solidified understanding of the rules of debits and credits goes a long way. Even for the most complex of Fortune 500 company, the basics of all transactions that are recorded tie back to this basic accounting equation and the rules of debit and credit. And please keep in mind, debit does not mean increase. It does not mean cash. What debit means in accounting is the left side of an account, and credit represents the right side of an account. And depending on the type of an account, that determines whether or not debiting, placing the amount on the left side, or crediting, placing the amount on the right side, whether or not there is an increasing or a decreasing effect. Next, we see steps 4 and 5. We put the data together, we assemble and we analyze it, and then we essentially prepare our adjusting journal entries. And then from there, our adjusting journal entries would be journalized and posted to the ledger. And then from there, we prepare our adjusted trial balance. Once that's complete, we essentially prepare our financial statements, our income statement, statement of stockholders' equity, and a balance sheet. And then from there, once the financial statements are issued, we prepare the closing entries, journalize them, and then a post-closing trial balance is prepared. So here in this example, we have an illustration of the accounting cycle. So in this section, the complete accounting cycle for one period is illustrated. It says Kelly Pitney has operated a part-time consulting business from her home. As of April 1st, 2008, Kelly decided to move to rented quarters and to operate the business on a full-time basis. So the first step in the accounting cycle is to analyze and record transactions in the journal using the double entry accounting system. So the transactions are analyzed and journalized as follows. So step 1, we have to ensure that we carefully read the description of the transaction. So that way we can determine whether an asset, liability, common stock, retained earnings, dividends, revenue, or expense account is affected. From there, For each account affected by the transaction, we determine whether the account increased or decreased. And from there, we determine whether each increase or decrease should be recorded as a debit or a credit, following the rules of debit and credit. From there, we record the transaction using a journal entry. And the company's chart of accounts is useful in determining which accounts are affected by the transaction. So here we see the chart of accounts for Kelly Consulting. We have cash, accounts receivable, supplies, prepaid rent, prepaid insurance, office equipment, and accumulated depreciation. So accounts 11, 12, 14, 15, 16, 18, and 19 represent our assets. 21, 22, and 23, these accounts represent our liabilities. 31, 32, 33, these represent our stockholders' equity. And then our 41, 51, 52, 53, 54, 55, and 59, as we discussed a little earlier, these revenues and expenses also impact our stockholders' equity, as they are a component that has an increasing effect on retained earnings if there's net income, and a decreasing effect if there is net loss. So here we see these journal entries for the month of April. So we have various transactions that essentially took place. We analyzed each of them and recorded them. And now, after all of these transactions have been recorded, the next step is that we have to post them to the ledger. So periodically, the transactions recorded in the journal are posted to the accounts in the ledger. The debits and credits for each journal entry are posted to the respective accounts in the order in which they occur in the journal. So therefore, they are listed in chronological order. Journal entries are posted to the accounts using the following steps. Step 1, the date is entered. Step 2, the amount is entered into the debit or the credit column. Step 3, the journal page number is entered into the posting reference column. And step 4, the account number is entered in the posting reference column in the journal. So the journal entries for Kelly Consulting, they've been posted to the ledger. Now for step 3, we prepare an unadjusted trial balance. So an unadjusted trial balance is prepared to determine whether any errors have been made in posting the debits and credits to the ledger. The unadjusted trial balance shown in a previous exhibit 11, it doesn't provide complete proof of the accuracy. Again, maybe it could have been recorded in an incorrect account. The key thing with the unadjusted trial balance is that it indicates that debits and credits are equal, therefore, proper double entry bookkeeping took place. This proof is of value, however, because errors often affect the equality of debits and credits. So if the two totals of a trial balance are not equal, an error has occurred and it must be discovered and corrected. So this represents our unadjusted trial balance for Kelly Consulting. We have our assets, we have our liabilities, our revenue, as well as our expenses and our common stock. So now for step 4, we assemble and analyze the adjustment data. So we know that before the financial statements can be prepared, the account balances need to be updated. The 4 types of accounts that normally require adjustments include accrued revenues. This represents revenue that the business has earned, but they have not yet received payment. Accrued expenses, this represents expenses that have been incurred, but they were not yet recorded or paid for. Next, we have unearned revenue. This represents monies that the company receives in advance before they perform the service, before they sell the product. And lastly, prepaid expenses. These are expenses that are paid in advance before the expense is actually occurred. In addition, depreciation expense must be recorded for fixed assets other than land. So the following data has been assembled on April 30th, 2008 for analysis of possible adjustments for Kelly Consulting. So there's some insurance that expired in the amount of $300. Supplies on hand at the end of the month was 1,350. Depreciation on the office equipment for the month was $330. The receptionist worked, but we didn't pay as yet, so there's an accrued expense for $120. Rent expired during April is $1,600, and unearned fees on April 30th are $2,500. So although an end of period spreadsheet is not required, especially now where we live in this day and age that a lot of bookkeeping and accounting is done in a computerized fashion, it is useful in showing the flow of accounting information from the unadjusted trial balance to the adjusted trial balance. So in addition, an end of period spreadsheet is useful in analyzing the impact of proposed adjustments on our financial statements. The end of period spreadsheet for Kelly Consulting is shown in the next slide. So here we see our unadjusted trial balance. Then we record all of the adjustments that were necessary. And now we have our adjusted trial balance for which we can use to prepare our financial statements. So we see that the beginning balance for our supplies was $2,200. And now on the adjusted trial balance, the balance for our supplies is $1,350. For our prepaid rent, the beginning balance was $4,800. And now at the end of the month, it's $3,200. So it is definitely important to record these accruals and deferrals as well as depreciation expense because it has an impact on the accuracy of the financial statements. So for step 6, based on the adjustment data shown in step 4, the adjusting entries for Kelly Consulting were prepared as shown in the upcoming exhibit. So each adjusting entry affects at least one income statement account and one balance sheet account. Explanations for each adjustment, including any computations, they're normally included with each adjusting entry. And each of the adjusting entries shown is posted to Kelly's Consulting ledger, shown in Exhibit 18, which we will see shortly. And the adjusting entries, they're often identified in the ledger as adjusting. So if you're using a program such as QuickBooks, generally what you would do is in the title of the journal entry that you are recorded, you would record it as adjusting, and there's also a checkbox which lets you know that this is an adjusting. So here is our journal for the adjusting entries that were recorded. And for step 7, we prepare this adjusted trial balance. So after the adjustments have been journalized and posted, an adjusted trial balance is prepared to verify the equality of the total of the debit and credit balances. This is the last step before preparing the financial statements. If the adjusted trial balance does not balance, an error has occurred, must be found and corrected. So the adjusted trial balance for Kelly Consulting as of April 30th, 20-year 8 is shown in Exhibit 18 on the next slide. So here in this example, we see our adjusted trial balance. We have our updated balances for the accounts that are impacted by the accruals, deferrals, and depreciation expense. So now we are ready to prepare the financial statements. So the most important outcome of the accounting cycle is the financial statements. The income statement is prepared first, followed by the statement of stockholders' equity, and then the balance sheet. The statements can be prepared directly from the adjusted trial balance, the end of period spreadsheet, or the ledger. The net income or net loss shown on the income statement is reported on the statement of stockholders' equity along with any dividends. And then the ending retained earnings balance is reported on the balance sheet with common stock as part of the stockholders' equity. And stockholders' equity is then added with total liabilities to equal our total assets. So here we see our financial statements. We start off with the income statement. Revenue minus expenses gives us net income of $18,300. From there was no additional issuance of our, well, here we see we start with the beginning balance, 20-year 8 of 0. And then we issued common stock of 30,000. Net income and dividends does not impact our common stock balance. So therefore, Our ending balance for our common stock is 30,000. We had a zero beginning balance for our retained earnings because, again, this is a new business. We had net income of 18,300 and we paid dividends of 6,000. So therefore, our retained earnings balance as of April 30th, 20-year 8 is 12,300. We add the two together, our total stockholders' equity is 42,300. And then from there, we prepare our balance sheet. We have our assets, our liabilities, and the ending balances for our stockholders' equity stems from our statement of stockholders' equity. Now for step 9, the two closing entries for Kelly Consulting are shown in Exhibit 16. And as we pointed out, if we do not close our accounts, we are in the red. So we need to close our revenue, our expense, and our dividend accounts. So after the closing entries are posted, Kelly Consulting's ledger has the following characteristics. The balance of retained earnings of 12,300 agrees with the amount reported on the statement of stockholders' equity in the balance sheet. The revenue, expense, and dividend accounts will have zero balance. The closing entries are normally identified in the ledger as closing. And in addition, a line is often inserted in both balance columns after a closing entry is posted. This separates next period's revenue, expense, and dividend transactions from those of the current period. So here we see we debit our fees earned to decrease the balance. We credit our expense accounts to decrease the balance. And the difference, which represents net income, is credited to retained earnings. And from there, we debit our retained earnings and credit our dividends balance to decrease the balance to zero. So step 10, the final step, is to prepare a post-closing trial balance. A post-closing trial balance is prepared after the closing entries have been posted. The purpose of the post-closing trial balance is to verify that the ledger is in balance at the beginning of the next period. The accounts and amounts in the post-closing trial balance should agree exactly with the accounts and amounts listed on the balance sheet at the end of the period. The balances shown in the post-closing trial balance are taken from the ending balances in the ledger that was shown in Exhibit 18. So here we see our post-closing trial balance. We no longer record our revenue or expense accounts because they have been closed out. And this shows our ledger. Here we have our asset accounts. We have a few more asset accounts, and we also have liability accounts. And we also see our common stock with the ending balance. We see our retained earnings. And then we see here their closing entries for our fees earned and our expenses. So the balances are zero in preparation for the next accounting period. So why is the accrual basis of accounting required by GAAP? And we know GAAP stands for Generally Accepted Accounting Principles. So to understand why the accrual basis of accounting is required, it's first necessary to consider the alternative. So the primary alternative to GAAP is the cash basis of accounting, which records transactions only when cash is received or cash is paid. The accrual basis of accounting, however, uses the revenue and expense recognition principles to record revenues and expenses. So under the revenue recognition principle, revenues are recorded when earned. And revenue is earned when the services have been performed or products have been delivered to customers. The reason why this is so important is because customers can pay us after we've earned the revenue, or they can pay us before we've earned the revenue. So this can cause a bit of distortion. So the key thing is to ensure that we're only recognizing revenue when it is earned. That is why we use the accrual basis of accounting. The same thing applies to expenses. Under the expense recognition principle, the expenses incurred in generating revenue are recorded in the same period as the related revenue, and this is often referred to as the matching principle. So this will be the difference for net solutions if we use the accrual basis versus the cash basis, our income statement. So our fees earned for net solutions was $7,500 under both methods, $7,500, $7,500. And here we see that there's a distinction between our wages, our wages expense ties, but there's a distinction between our supplies expense. Our rent expense is the same, $800 for each. Utilities expense is the same for both, and our miscellaneous expense is the same for both. But here we see that there's a distinction between our supplies expense. So the distinction between the two is because we essentially see that the difference has to essentially do with the supplies that were purchased. So there's a difference of $150. So obviously this is on a very small scale showing the difference, but obviously this can have a great impact. So this is for the month of November. Next, we look at the month of December. So for December, under the accrual basis method of accounting, we earned $9,460 worth of revenue. And for the month of December, under the cash basis, we received $6,980 worth of revenue. So we see there's about a difference of $3,000, right? So our wages expenses are a bit distorted. We see that our wages expenses on the accrual basis, we recognize the fact that our employees worked for us and we didn't pay them right away. We see that there's a distinction between our supplies expense. So under the accrual basis, again, we don't care. Did we incur the expense? Doesn't matter if we paid for it. The key thing is, did we incur the expense? If yes, we record it. But we can see that that is not the case under the cash basis. Under the cash basis, we know that we paid $2,400 for a 2-year insurance policy, but it is being deducted as an expense in full under the cash basis method of accounting versus the accrual basis, where we are only recognizing it for the period that was incurred, which is 1 month. So therefore, there's a distinction. Again, the key thing is that under the accrual basis, we recognize revenue when earned and we record expenses when incurred. Under the cash basis, the only thing that we record or any transactions that impact cash. If cash was received, we recognize the revenue, and if cash was paid, we recognize the expense. So under the accrual basis of accounting, the interpretation is that net solutions is profitable and that they're rapidly expanding. But if we look at the cash basis of accounting, net solutions is in trouble because they have declining revenues and their expenses are increasing, hence why in December there was a net loss. And this suggests that Net Solution may not be able to continue as a viable company without significant operational changes. So we have to keep this in mind. We're looking at this from a very small scale, but imagine there are companies that have hundreds, thousands, millions, billions of dollars. So there can be a great distinction between our cash basis method of accounting and our accrual method of accounting. And another reason is that some companies, they will be very, smart, very savvy. What a company might decide to do, let's say they want their net income to be lower and they're using a cash basis method of accounting, they'll say, hey, don't pay us until next year, right? Or maybe they'll pay an expense in advance. They'll pay for a large expense because they want to be able to write it off in the specific year. So under GAAP, this helps to avoid any, fraudulent activities or any ways in which to evade or to impact the bottom line, which obviously will have an impact on taxes due. So we start to look at what's called working capital and current ratio. So the ability to convert assets into cash is called liquidity, while the ability of a business to pay its debts is called solvency. Two financial measures for evaluating businesses' short-term liquidity and solvency are working capital and the current ratio. Working capital is the excess of the current assets of a business over its current liability. So simply stated, working capital is current assets minus current liabilities. Current assets are more liquid than our long-term assets because they can be more readily turned into cash to meet short-term obligations. So for example, if I have a piece of inventory, let's say I have inventory or accounts receivable versus I have a home, right? Or a building. It's a very long process to go through the closing process to sell the property versus if I have inventory, I can sell it. So it's easier to turn that inventory into cash versus a building. So thus, an increase in a company's current assets increases or improves its liquidity because these assets are available for use other than paying current liabilities. A positive working capital implies that the business is able to pay its current liabilities and is solvent. Thus, an increase in working capital increases or improves a company's short-term solvency. So to illustrate, Net Solutions working capital at the end of 20-year 3 is $6,355. Current assets are $7,745, and current liabilities are $1,390, which leaves us with a working capital of $6,355. So another measure is the current ratio. And the current ratio is another means of expressing the relationship between current assets and current liabilities. The current ratio is computed by dividing current assets by current liabilities. So to illustrate, the current ratio for Net Solutions on December 31st, 20-year 3 is 5.6 rounded, and it is computed as follows. Current assets, which is 7,745, and instead of subtracting it, in this case, we are dividing it by current liabilities, which is 1,390. So the current ratio is more useful than working capital in making comparisons against companies or with industry averages because it can be skewed if you use working capital. So imagine you're using working capital and you're using a Fortune 500 company, a really large company, and their numbers are more than likely in the millions versus a mid-sized company where maybe their numbers are in the 100,000. So just looking at it, if you see a working capital of $1 million versus a working capital of 100,000, you might automatically be skewed to think that the bigger company is doing better. But once we utilize this ratio, it gives us a much better picture and we can compare it across companies or across industries based on the averages. So as it relates to the end of period spreadsheet, again, sometimes the spreadsheet is used and sometimes it is not. In a manual system, they may or may not use a spreadsheet, and in a computerized system, you more than likely won't have a spreadsheet, but you can, essentially print out transactions. So there is a way for individuals who use a computerized system to generate an end of period spreadsheet. So accountants often use spreadsheets for analyzing and summarizing data. Such spreadsheets are not a formal part of the accounting records. This is in contrast to the chart of accounts, the journal, and the ledger, which are essential parts of an accounting system. So with the end of period spreadsheet, we would enter the title, enter the unadjusted trial balance, enter the adjustments. The adjustments are normally entered in the order in which the data are assembled. We would enter the adjusted trial balance, extend the accounts to the income statement and balance sheet columns, and then we would total the income statement and balance sheet columns, compute the net income or loss, and complete the spreadsheet. The spreadsheet can be used to prepare the income statement, the statement of stockholders' equity, as well as the balance sheet. And when a spreadsheet is used, the adjusting and closing entries are normally not journalized or posted until after the spreadsheet and financial statements have been prepared. So here we have an example of what this spreadsheet looks like. Again, we start off with the unadjusted trial balance. From there, we have our adjusted trial balance, and we have a column for the accounts that impact the income statement, and then the accounts that impact the balance sheet. So here we have the adjustments that need to be accounted for. From there, we have the updated balances in our adjusted trial balance. And then from there, we start to prepare, or we transfer over the accounts that impact the income statement, which is our revenue and expenses. And then the accounts that impact our balance sheet, which are the asset, liability, and stockholders' equity accounts. And then here now we have the completed spreadsheet with the net income shown. So the net income, as we know, is the difference between revenue and expenses. And then this difference between the balance sheet total credit columns would essentially tie now, because the impact of the net income would cause it to balance. And next we have the statement of cash flows. So the statement of cash flows that would accompany the net solutions income statement, statement of stockholders' equity, and balance sheet is shown on the next slide. So as we know, we have operating, we have investing, and we have financing activities. So these are essentially the activities that businesses will take place. Operating activities, these are essentially the day-to-day operations. Investing activities is when they are essentially purchasing assets and things of that nature. And financing essentially represents the things that are done to finance the operations of the business. So when the company issues common stock, or they sell bonds, or they pay out dividends, or they pay interest, those things have an impact on the financing activities. So the statement of cash flows shown was prepared by classifying the November and December cash transactions of Net Solutions into these three categories: operating, investing, or financing activity. So we purchased land, this was investing. We paid expenses in a normal course of day-to-day operations, that's operating. We paid dividends, that's considered operating. We paid accounts payable for our office equipment, that's investing. So it's very important to be able to distinguish between the three types of activities, so that way the statement of cash flows can be prepared accurately. So this brings us to the end of chapter 4, the accounting cycle. Now that the lesson has ended, you should have learned how to describe the flow of accounting information from the unadjusted trial balance into the adjusted trial balance and financial statements, prepare financial statements from adjusted account balances, journalize closing entries, describe the accounting cycle, illustrate the accounting cycle for one period, explain why the accrual basis of accounting is required by GAAP, describe and illustrate the use of working capital and the current ratio in evaluating a company's financial condition, describe and illustrate the end of period spreadsheet, and prepare a statement of cash flows from a cash account.